All right, let's go ahead and get this started. My name is Joe Pivarunas. I'm the founder and managing editor of Nanalyze. We're a boutique media and research firm that covers disruptive tech for a broad audience of retail and institutional investors. Now, about half the people that read our content, let's say half the retail investors, are beginner investors. So we put together a research piece on what are the absolute basics you ought to know if you're just dipping your toe in the water of investing. And we wanted to call this, a beginner's guide to investing and all that. But I think more importantly, it's what every beginner investor needs to know. It's not everything you need to know, but it's enough to keep you from getting in trouble. So today, we want to focus on going over the basic principles of investing. We want to cover pitfalls, what sort of approach you should take, what are the things that you need to watch out for, what's important to focus on. Questions, go ahead and pop these into the comments section. This will be published on YouTube, so put those into the comment section. We'll answer them. And of course, feedback is always welcome on everything that we talk about today. So there's some good news and bad news in terms of the person that's talking to you. So the bad news is that I come to the table with a lot of academic qualifications. So I did a bachelor's in computing, a master's in business with a focus on finance, and then a master's in finance. And I learned very little from those degrees other than how to hustle to get a job afterwards and how to pay off a large amount of debt that these degrees accrued. What I did learn from is the experience that I had working. So I spent 5 years in the service industry hustling from the age of 16. I worked in a sawmill, I waited tables, I washed dishes, I cleaned hotel rooms, did everything I could possibly do to raise money. And then when I did my degrees, I worked through those as well, except for my MBA. I took a year and a half off. So I spent about 10 years working in software, another 10 years in finance. And most importantly, the good news is that I've made every investing mistake in the book. So a lot of what I'm going to talk about today, I wish somebody would have told me, and they may very well have told me, and I just didn't listen. And that's the other thing that you need to pay attention to. So you, the best thing you can do is learn for yourself. So you may not heed the advice, but the best way to do it is to figure it out for yourself and to make your own mistakes. So financial advisors, we'll talk a bit about that. We're not financial advisors. I'm certainly not qualified to be a financial advisor, don't want to be a financial advisor. What we want to do is teach you how to fish. So a financial advisor will direct you to where the fish is, and then without them, you're lost. But we want to make sure that you understand how to catch your own fish. A lot of people, and here's the thing, right? So if you look at money managers, these are people whose job is to beat a market benchmark. So you can think of them as stock pickers. 95% of finance professionals can't beat the market in the long run. And nobody really wants to tell you that. Nobody wants to admit that. Going to uni and spending a whole bunch of money on that degree didn't really make you better at gauging the market. So there's the old adage about the guy who goes into the financial firm to get advice. He drives a Bentley to get advice from somebody who rode in on the train. That just doesn't seem right. So you need to be very aware of the fact that few financial advisors can beat the market. What a lot of financial advisors will do will competently tell you that the best way, the basic principles, diversification, index funds, things like that, passive versus active. So many smart people out there will say, well, if 95% of managers can't beat the market, why don't I just have a go at it myself? And it can actually be really enjoyable. Investing is a lot of fun. You learn a lot, and it's really a rewarding endeavor. So the ideal situation for a beginner investor is something like this. Pre-college, you are not taking on a lot of debt. So you're figuring out what's the best education you can get to maximize your income and at the same time enjoy what you do. And that's a difficult thing to do. And during college, you don't take your college loans and blow them blow them at the bars, or try to invest that money or do anything foolish with it. You try to take on as little debt as possible. You always try to take on as little debt as possible. And then after college, when you start your first job, that's when you actually start to have money. And we're assuming most of the people that are beginner investors start right about there. Once you have your first decent paying job, you get your loans paid off, you live below your means, and you start investing. And that's usually that's the sweet spot, the ideal sweet spot. Now, you may arrive at that sweet spot earlier or later than others. it doesn't really matter. What matters is that you're here now learning about investing and that you want to invest. You understand the importance of investing. The next biggest thing that you need to consider is the notion of dollar cost averaging. So sometimes people will come across a lump sum of money and they'll try to invest that all at once, and that's very tricky, because what happens there is that you're trying to time the market. What you want to buy low and sell high, right? So you're trying to figure out where to buy low. Well, that's difficult. What you can do is you can take a little bit of money each month and invest in the same thing. So that's called dollar cost averaging. It smooths things out over time and eliminates market timing risk. So things that you need to consider: your income potential. So maybe you're a retiree who already has accumulated all your wealth, in which case you're probably worried about wealth preservation more than you are about growing your wealth. So wherever point you're at, if you the biggest asset you have is your income potential, if you still have that, because that's what you're able to use to build wealth with. Cash flows. So you have to live below your means. That's extremely important. So the cash flows that you get, you spend as little money as possible and you maximize. And there's plenty of websites and people that talk about living frugally and all that, fire and all that stuff, right? That's not what we're here to talk about. We're talking about people that actually have money to invest, for however they manage to get that. And you need to consider when you need your money. Well, for most people, that is going to be when you're 65, maybe 65 and beyond. So the closer you get to needing your money, the less risk you're going to want to take. That's basic stuff. Any financial advisor will focus on that. Figure out where you're at in your life and what sort of risk you can afford to take. What you spend your money on is very important. So if you have to vet everything, every expenditure that you have, because every penny that you don't save is money that you could have saved. So living below your means, these are all obvious things. And again, these things sort of just go without say, and you have to really hustle, right? That's one thing that nobody wants to say, is that the harder you work, the luckier you get. And you've really got to hustle if you want to accumulate wealth. And you've got to start as early as possible. So here's a good example of what a financial advisor would suggest for people that, and again, the age range here is a bit higher, but you can see that at age 48, let's say 90% in stocks, 10% bonds. And then as you get older, eventually you move towards lesser money in stocks and more money in bonds. Now, this strategy that you see here, this profile, was taken from Betterment. Betterment, great firm. So if you were going to do the absolute minimum to invest for yourself, you go to a robo-advisor like Betterment or some of the others out there. It's been a while since we looked at what's on offer, but these robo-advisor firms, and you can see here they're invested in Vanguard ETFs, which are some of the lowest cost ETFs out there. And heck, if you just want, you could mimic what they're doing here, open up a brokerage account, buy these same Vanguard ETFs, and adjust the weightings as time goes on. There's absolutely nothing wrong with this strategy. It's the traditional advice that's dispensed by financial advisors. It always has been. It's always some combination of fixed income and equities. And it's maybe very boring, but it's also very effective. Now, those who want to manage their own assets, you're going to want to start by taking a holistic look at what we call asset class allocation. So here's just an example of what asset class allocation might look like. You might have some index funds. Those could be in a 401k. They could be in a brokerage account that you have. So you have this collection of index funds. Then you have some stocks that you bought. So you're doing some stock picking and you've got a little portfolio of stocks. You've got some home equity, and then you've got your 401k. Maybe that isn't part of your index funds, but the idea here is that you need to start by looking at where you've placed all your bets so far. That's critically important, because diversifying across asset classes, this is how professional money managers look at managing money. They say, all right, I'm not going to just put all my money in stocks and bonds. I may want to start looking at other asset classes such as real estate or alternative assets like gold or, arguably Bitcoin, wine, art, things like that. So the first thing you need to do is take a look at all the assets that you have. Don't include your car in that. All the assets that you have and say, how, if that home equity category is 80% of your wealth, then you really need to think about that. Now that's the situation that a lot of Americans end up getting themselves into. See, not just Americans. We have people, readers from all across the globe, that a lot of people get themselves into a situation where the majority of their wealth is tied up in their home. Now, that's that it is what it is, but you have to realize that you're taking a lot of risk, because now you have one home, one property, one location in one city, in one state, in one country, and that's where you've placed all your bets. So you have a lot of risk specific to that home equity. Now, our asset class allocation, this is what it looks like. This is actually from all the assets we have under management, our portfolios and whatnot. And you can see here that over half of our assets are in a dividend growth investing strategy that's called Quantigens. That's our biggest allocation. Then we have tech stocks. That's what Nanalyze is about. Today, we're not going to talk very much about tech stocks. Then we have some European funds, some Asia funds. You always want to have international exposure to avoid something called domestic bias, which is putting all your chips in the familiar stocks in your backyard or in the country that you reside in. You want to make sure that you're getting global exposure. And we have some cash, and of course, cash isn't getting any value just sitting there, but it's cash as it is, because the interest rates aren't very high right now. And then we have what's called alternative assets. So wine and art, mainly because these are fun things to invest in. There's very strong arguments why these are good alternative asset classes, but they're also very fun. If you enjoy drinking wine, you're gonna love investing in wine. And art is also enjoyable. Then there's Bitcoin, which has been on hitting the skids lately, and then some gold. So you may want to break down your own assets into groupings so you can see where you've placed your bets. Now, what people that start to have money to invest or have money to invest will do, it's never the people that have a lot of money that they created themselves by busting their asses, because then they would be too scared to lose it, and they wouldn't go doing something foolish like plugging in what most people do is they go to Google and they plug in stocks to buy now, best stocks to buy, should I buy stocks? They try to ask Google all these questions. Well, you're gonna have a million people out there that want to give you the answers to these questions. And the truth of the matter is that there is no best stock to buy. It's a fallacy to think that you're going to find the next Microsoft, or you're able to cherry pick the right stock. Trying to find the best stocks to buy right now, or even having this notion of best stocks in your mind, you need to get rid of that real quick, because that's a surefire way to lose money. Another surefire way to lose money is by day trading. So this is a great little chart here that shows ideas that sound smart, that are actually smart, that sound smart, that are actually dumb, and that sound dumb and are actually dumb, and that's day trading. So you're not going to day trade your way to a better zip code. You will always lose your money, and that's because you're competing against extremely sophisticated hedge funds that have employed AI algorithms that pretty much just go around taking everybody's money. That's the reality of things. So it doesn't matter what somebody's trying to sell you on some trading strategy, it's never going to work. Other bad ideas include trying to look for the next Microsoft or the next Tesla. Again, trying to cherry pick a stock and put all your eggs in one basket. Applying legitimacy to over-the-counter stocks. Over-the-counter stocks, penny stocks, you avoid, period. There are no exceptions, ifs, ands, or buts. It is completely avoided. That whole genre of junk is avoided. You don't get involved in that. You'd be blown away by how many people, even somewhat sophisticated investors, will try to dabble in that space, and it's just a fool's errand. You don't touch penny stocks, and you stay away from that garbage. And then there's this notion of investing in everything with Google, where you pick one particular stock, and then all of a sudden that gives you exposure to robotics, and that gives you exposure to all these different things. Always look at what a company does, what they make their money on. That's what you're investing in. So there's a lot of dumb things that you can do with your money. The smart things to do with your money are to find safer strategies. Now, getting rich, nobody wants to tell you this, is a long, boring process. It takes a lot of hustle to create the money that you need to invest the money. So good ideas. Diversification across asset classes, we talked about that earlier. Diversification within asset classes. So if you look at those portfolios we had, in each of those portfolios, our dividend growth portfolio has 30 stocks, our tech portfolio has close to 40. So diversification within each asset class is very important. Our European funds, I think there's 5 funds there. Our Asia funds, there's 6 funds there. So within each asset class, you need diversification. That's why when you look at realty, at home equity, that's not diversification. Now, if you owned a handful of REITs, so we do own some REITs, those are actually included in our dividend growth strategy, then that's considered diversified exposure to real estate. This notion of dollar cost averaging, so buying a little bit as you have the income, buying a little bit every month for as long as you possibly can, as long as you have income, starting as early as you can. Then once you start to accumulate wealth, so let's say you get into your 40s or 50s and you've accumulated a decent amount of wealth, well, preservation becomes pretty important for 2 reasons. One, you have something to lose. So you don't want to lose all that wealth that you work so hard to accumulate. And the second point there is you're going to need to spend that money pretty soon. You're getting close to retirement. So what you may want to look towards as you get older, or even as you're younger, is, and of course when you're younger, you can take more risk, but really need to lean towards safer investment strategies. And we put quotes around that because no investment strategy is safe. But we want to give you an example about an investment strategy that we've developed for ourselves. This is something that myself and Peter, who works with me, we worked together at a large financial services firm for around a decade, and we built this strategy. And it's based on an unmet need that we came across. So when you're putting together your own portfolios and strategy and looking at, get yourself a spreadsheet, right? Put everything in there and run numbers, learn how to use Excel. It'll do wonders. So when you're starting to look, do forward-looking estimates of what you'll need in retirement, what you have now, how you'll get there. One unmet need that we immediately identified was this notion of income not growing when you need it. So the phrase fixed income that usually refers to bonds, and it is what it says on the tin. It's a fixed income stream. Social Security, let's say, fixed income stream. Well, what's the problem with that? Let's say that you're 60 years old, all right, and you have a fixed income. By the time you get to 90, that income stream has halved. The purchasing power has halved. Why? Inflation, right? Every year there's inflation. The purchasing power of your money decreases. That's a big problem. First of all, when you get older, you've got to worry about your health decreasing every year. That's bad enough. Who the hell wants their quality of life to increase every year that goes on? That doesn't sound very good. So one way you could solve that is by taking your wealth and then paying yourself more every year. What's the problem there? Well, you're going to run out of money sooner than you think. So that isn't an answer. So what we ideally wanted, and it's a lot to ask for, we want capital appreciation and income appreciation. Okay, so that's in an ideal world. And then we also wanted a strategy that was resilient to economic turmoil. So a strategy that would be able to survive recessions, because you never know when a recession is going to happen. So the strategy we developed is called Quantigens. And this chart here, I think this is a tobacco company, gives you an example of the power of dividends. So here's the stock price return over a period of time. I think 30 years or so. And you can see that the total return, let's say, not total return, price return, is about 4,000%. And then that green line shows you when dividends are added, how dividends increase that return to 18,000%. So the longer that time goes on, the bigger impact dividends have on your total return. Dividends are a huge component of return in the overall stock market. You could put up the S&P 500 and run a similar chart like this. So we spent over about a decade building out a strategy that focused on dividend growth investing. So here's an example. Let's say you have a company, and there's quite a few. We have 72 companies we've identified that not only paid a dividend every year, increased it every year for at least 25 years in a row. Think about that. That's quite remarkable. So if you had a company that was paying you a dividend that was growing at, let's say, 9%, okay? At year 0, you have $1,000 in income. At year 1, you have $1,090. It's growing at 9%. At year 2, $1,188, and so on and so forth. By the time you get to year 30, remember, that's when your income would have halved. You're making over $13,000 a month. That's the power of compound growth over time. Now, of course, an income stream growing at 9%, you still need to take into account inflation, whatever that might be, let's say 2 to 5%. Taking into account inflation, you're still beating inflation, which means that the quality of your life is increasing as time goes on. So this idea of an income stream that grows is very powerful. Now, this 9% number, we didn't just make this up. This is the average growth of the dividends coming from the 30 stocks in our portfolio over the last 10 years. That's 30 stocks on average. They grew their dividend by 9% every year. And of course, as every year goes on, that number changes just based on the averages, but that's very powerful when you have an income stream that's growing at 9%. And that's the basic idea behind dividend growth investing. Now, there's another thing to realize here. And again, this is how Warren Buffett got wealthy. And it's this notion of yield on cost. So, and these numbers aren't exact, but they're close enough to use as an example. Warren Buffett bought Coca-Cola way back in the day, and he paid around $1.3 million for 400 million shares at about $3.25 per share, let's say split adjusted. So he made that investment, and then what? Coke's share price today, let's say, anywhere from $40 to $50. Haven't looked at it recently. So he's made that capital appreciation. You buy something at $3.25 a share, $50 a share. You could do the math on that. But that isn't even the good part. Here's the good part. So Coke's annual dividend in 2020 was $1.64 per share. That means that in 2020, Warren Buffett made half his investment back that year. And in 2021, Coke's going to increase. I think Coke's increased their dividend now for, 40 years or so. Coke's going to increase their dividend again by 9%, and that number is going to go up. So that in 2020 and 2021, Buffett will have made his money back just in those 2 years based on dividends and nothing else. So that's going back to the example about how powerful dividend is. What a critical component of total return dividend is. So this is an example. This is referred to as yield on cost. So the money that you put into that dividend stock and then you leave it there, as that dividend grows, the money you put in doesn't change, but the yield on that money you put in does change, right? Now, the yield on the price of the stock, that's different, but the yield based on the money that you put in, growing every year, your yield increases, and then you can end up in a case like this when your yield is 50% of the money you put in. Now, just prior to this presentation, I was crunching some numbers, and we've had our dividend growth portfolio for quite a while. And I was doing some of the math on yield on cost, and it's quite fun to see. You have a stock today that's paying, 2.5% yield. Oh, that sounds real low. But then you look at the yield that you're actually getting based on the money you put in and the growth that's happened over the years, and suddenly around 6 or 7%. So that's a great yield to be receiving on your capital, plus the share price appreciation. So you're getting, remember, we talked about capital appreciation and income increasing over time. So these are very powerful concepts to think about. Now, what we did is we put together a report. Obviously, we're selling something. Everybody is, but we put together a report that shows how we built our dividend growth portfolio. And right now, this is only available to subscribers at Nanalyze. So that's how you get that report. But of course, we don't expect you to buy that report. We built something for you that you can use for free. If you go to Quantigens.com, and this is a website that describes dividend growth investing, and you click that link there, Q-score calculator, that will pull up a calculator that shows you 72 stocks, and these stocks are ranked by their likelihood of maintaining and increasing their dividends as time goes on. And you can see we call that a Q-score, and they're all ranked by Q-score, and you can filter on sector and whatnot. And this gives you a list of some very interesting stocks that few would argue are quality names or aren't quality names. So if you're thinking about building your own dividend growth investing portfolio, then this would be a useful tool to have. Now, when we look at, we call this a Q score, we look at a company's ability to pay and increase dividends, we take into account 7 factors. The first is, how many years have you been increasing dividends? So at least 25 just to get in the door. That's called a dividend champion. Market cap. Bigger stocks are always better. Economies of scale. Yield. Higher is better, but chasing the highest yield is not a very good idea. And that's mainly because the higher the yield gets, the more likely investors believe that they're not going to be increasing their dividend as time goes on. You can see with AT&T and Exxon during the oil crisis and Chevron, and these are some examples. Payout ratio. So when a firm has profits, there's a certain percentage they pay out to investors in the form of dividends, and the rest they invest in buy back shares or invest in the company, whatever. So the lower the payout ratio, that means the smaller amount of money taken from earnings being given in the form of dividends, means they have a lot of buffer to increase that dividend as time goes on and not to ruin their track record. International sales, we like companies that are multinationals. That avoids the domestic bias. And then, of course, we reward 5-year dividend growth and 10-year dividend growth. So this is an example of a method that we would use to go through and to evaluate stock, high quality assets to hold over time. And here's an example of what that looks like for a particular sector. You can see McDonald's sitting at the top. That's because McDonald's is a great company. You can see other names here. Lowe's, you see where we've penalized them. Well, yes, they're penalized for not having any international sales. So part of the strategy is that this will go through for each factor and either reward or penalize. And you can see where we've penalized Lowe's for not being international, along with Target and GPC. So that's just a quick summary of one way that you can go about building a portfolio of stocks. When you're building a portfolio, here's some things to think about. Number of constituents. So, there's a lot of academic debate about how many stocks you ought to hold. So you need to consider that. We'll touch on that more in a second. Yield, as I said, if you're building a portfolio and you need more income now, you may tilt towards higher yield stocks, but the best thing that you can possibly do is something called DRIP, which refers to a dividend reinvestment plan, which means that every dividend that gets paid, you just buy more shares with it, and that will increase your holdings very quickly over time. So let's say you're putting in money every month into a portfolio of stocks, and then also when those stocks are paying dividends, those dividends are going right back into the stock. Schwab will let you do that. You can turn on DRIP for all your dividend stocks, and it will automatically do that. Industry diversification, very important. So if you're building a dividend stock portfolio, you want to make sure you diversify across industries, because some are cyclical. Some industries behave real well during recessions, like Walmart and McDonald's. People want to buy cheap food and cheap products when there's a recession. So those companies historically have done well during times of economic turmoil. And then time to vest, you want to consider how long will it be before you need to start pulling some of this money out? And an example here, if you're thinking about investing in tech stocks, well, check this out. So the dot-com era, not too many people that are getting into meme stocks will have remembered what happened during the dot-com era. But when things crashed, stocks like Cisco and Intel fell over 80%. So if you had a $100,000 portfolio at the peak of the dot-com times, that would have been worth $20,000 when the dust settled. And that only took about a year or so. It then took 14 years for that $20,000 to get back to $100,000. So unless you were able to not need that money for a long period of time, you would have been forced to sell and been in a real bad position. So if you want to start investing in risky assets, first of all, you better buy quality so that they don't go bankrupt or go bust in times of economic crisis, like a lot of small firms do. You want to buy larger, safer companies, but you better have the ability to hold through paper losses that look like that, because what ended up happening was that most investors, when things started crashing, a lot of them were selling at the bottom because they just wanted to save something. And that's a real desperate situation to be in, especially when you made the worst possible decision. So when you're looking at number of stocks to hold, just to touch on that real quick. If you have a stock portfolio, academics say you should have, let's say, at least 20 stocks, ideally between 20 and 25 stocks to minimize your risk to a sufficient level. We have 30 and 40. Now, 30 is a nice round number that we've chosen for whatever reason for our dividend growth portfolio, and 40 for tech stocks. There's actually some math behind that. So if you're putting, I guess the takeaway here is if you're putting together a stock portfolio, don't have fewer than 20 stocks in it. And certainly never try to pick the next Microsoft or invest in just a couple names or one name. It's a very bad idea. Now, if you were ever going to invest in one name, Johnson & Johnson. So people sometimes ask the question, it's a good thought exercise. If you could only invest your money in one stock, what stock would that be? And people say Amazon and Tesla and all this. No. The answer is Johnson & Johnson. There's a lot of reasons for that. You could have its own presentation just around why that is. Now, when you're an investor in Johnson & Johnson, there's nothing exciting happening there. You don't go every day to your terminal and check the price because it's not doing anything. Johnson & Johnson is a very slow, boring stock that has created a tremendous amount of wealth over the years because the stock price appreciation here, this slow, boring growth, is also accompanied by the dividend growth. So stocks like Johnson & Johnson, there's nothing exciting about it. So it's kind of its own portfolio of little companies. Like 3M is another example of that. 3M is just a conglomerate. It's a collection of other companies. And they're well diversified within themselves, and not a lot of stuff happens, and they're safe and boring. And it's that slow, safe, boring path that often leads to large amounts of wealth. And once you dip your toes into the investing world, you're going to realize that very quickly. Now, just going back to our website here, this is where we've defined dividend growth investing and our particular strategy. So this is all the content here is free. You can sign up there to our newsletter or the Nanalyze newsletter. Now, just to summarize today, the earning power that you have is the single most valuable thing. You hear a lot of people complaining about, not being promoted or complaining just how unfair life is. And guess what? Life is really tough. And if you want to accumulate wealth, you have to hustle extremely hard. And you're going up against people that some of them are absolute psychopaths that will spend 70 or 80 hours a week trying to attain the same exact thing you are. So once you get into the corporate world, you're going to realize what an absolute mess it is, and that getting anywhere, everybody wants to be CEO, and you have a firm with 400,000 people, and how the hell do you make your way up to CEO? Well, there's a lot of people that have dedicated their lives and removed every possible distraction you can think of from their life just to get to a particular position. So it's a viciously competitive to accumulate wealth, especially when you consider the emerging markets that are now unleashing a lot of very hungry. We always used to look to hire PhDs. PhD stands for poor, hungry, and determined. Those are the sorts of people that you're going up against. So that earning power, you're going to have to work extremely hard to maximize your earning power. And then once you do that, you realize how hard it is to make money. Then you start to say this. You say, I'm going to make other people work as hard to take my money as I did to earn it. All right. And then you start living below your means because you realize that going with the EDs to that whiskey bar at $20 shots of whiskey after work is a fucking waste of money. So you stop doing things like that. Investing in low-cost index funds, so be careful about transaction fees, who you're paying money to, and what you're getting. So when you're buying any sort of fund or ETF or investment product, look very closely at the fees you're paying. Vanguard, solid, very solid. One of the lowest cost funds out there, fund providers out there is Vanguard. So it's a great firm, and just a name to remember, Vanguard, they're great. And then make sure that stock picking is fun, right? I mean, it's very enjoyable to manage your own portfolio. And if you have the time, that is, and we do that because it's our job, and we kill two birds with one stone, because as we're managing our portfolios, we're producing content and providing that to our audience in free form and in a premium offering. So That's our job, and it is quite enjoyable. But always make sure that when you're doing your stock picking, you're only doing so with a small percentage of your assets. You're looking for quality companies, and you have a long time horizon. Be very, very cautious. Everybody does this when they start investing. Some do it after they've been investing for a long time, looking in the short term. Oh, my portfolio is up 20% this week. My portfolio is down 20% this week. That's irrelevant. Those short-term price movements are irrelevant when you have quality assets. So be very careful about that. And going back to the original where we started out in this presentation about asset class allocation, start at the top, right? Be very aware of where your wealth is, how it's accumulating, where it's accumulating, and make sure you're sufficiently diversified. That's very important. And make sure that when you're buying assets, that you're not trying to time the market. You're using dollar cost averaging. So um, go ahead and sign up to our YouTube channel. If you have questions, post them in the comments section. Again, going back to the title of this, what beginner investors need to know, this is the absolute minimum that you need to know. Where you're really going to learn is when you start doing these things yourself. And like most people, when you're told best practices, you'll often deviate from those, and it's human nature to disregard what others say and to choose your own path, and you should. What you'll end up finding out is that you learn these lessons along the way, sometimes the hard way. So if you have questions or comments, drop them in the comment section there. We'll answer them for you, do what we can. Thanks so much for taking the time. Best of luck in your investing endeavors. You'll do great because you're out there looking for the answers, and you've at least found some of them today. So thanks for your time, and we'll look forward to giving more presentations in the future. So make sure you sign up to our YouTube channel.